All right, what's good, everybody? Welcome, welcome. Happy Tuesday already. Hope you're having a good day so far. Yesterday, pretty rough day in the market. If you've never watched this before, my name is Dustin Tibbetts, financial advisor with Jazz Wealth. We help you with your retirement accounts. And bear with us this week because we're doing a little bit of a geeky thing. Yesterday, we did a really sort of geeky video on the speed of your accounts. And I really want to keep focused on that. So with today's video, what we're going to do is sort of expand a little bit, but move directions to kind of explain speed. Now, one of the things that most people don't get is that the retail investor, those of you that go and buy mutual funds and exchange traded funds or stocks, you guys are buying stocks because you want to pick a winner. When you buy a basket of stocks and you end up with all these different stocks that you like, you are focused on the winners and the losers. When in reality, the real world, the big world, and tomorrow we're going to explain some of the biggest people on the planet, the biggest companies that you've never heard of that make more money than God, how they are focused on speed, right? And they're just these quiet little companies you never see on TV, you never hear anybody that works for them. So we're going to talk about that tomorrow, but they know to focus on speed. Every fund manager on the planet, every hedge fund manager, they know to focus on speed. And while it's fun to talk about winning stocks and losing stocks and, you know, the ones you struggle with and everything, the bottom line is it doesn't matter when it comes to your retirement investing. We want something that moves at a certain pace that we can quantify over the long term. We don't want to take guesses with your retirement. So at Jazz Wealth, all of our portfolios on our website, you just click on portfolios, look at the different ones, click on the one you're interested in, and you can see the performance. At the very bottom, actually I'll show it in a minute, but you can actually see the speed of the portfolio. So we'll go over that in a second. Now today, we're talking about dividends, and some of you are not going to like what I'm going to say, but keep in mind that what I'm talking about today is that for the younger investor that has more than 10 years left to retirement, probably more than 15 years left to retirement, you really want to be careful about focusing too much on dividends. And, you know, rather than just say that and give my opinion, I want to give you facts, right? So I always will say factual things about the market, its performance. I will always help our customers understand the facts rather than say, in my opinion, I think you should do this or this. I want to say, you need to do this because this is the actual thing. And actually, I'm going to do it again. If you're one of our customers and you haven't yet got this towel, it's on its way. Now, like 180 of them went out yesterday. So this towel here, I'm going to show it on the screen. It says 100% of the time the markets recover 100% of every decline, right? Or something very close to that. And so this is just like a little joke, like to wipe the sweat off. I'm not sweating it. We know that the markets recover 100% of the time. The real trick is to make sure you're invested properly, right? If you buy shares of GE and that's all you're invested in, I can't promise you that 100% of the time GE will recover 100% of its losses. I don't know if they're even, they're in the news today for spinning off a bunch of their companies. What I can say is that if you're invested correctly, then 100% of the time, whatever the markets do as far as the downside, the fall, that they will recover 100% of the time. And I've even given our customers the actual stats on how long it declines, what was the worst, what was the average, and so on and so on. But today we're talking about dividends. So by the way, if you're one of our customers and you want one of these, my daughter is working nonstop to fold them up, stick them in an envelope, and mail them out. So I've got her at home doing that while, it's summer. She's not doing anything, so she can do a little bit of work. Now, we're talking about dividend portfolios, and because I get a lot of the younger people that want dividends, because you're told that, right? It's just like index funds. You're told to put your money in index funds, but nobody ever says why. And don't tell me because it's cheap. Tell me what I'm going to get out of it. I don't want to know what I'm going to pay out of it. I want to know what I'm going to get out of it. Well, dividend portfolios can be really tricky because there's a sacrifice. Companies don't just pay out money because they're nice. They're paying it out because they have to. So I want to talk about that a little bit. I happen to think that we have the best dividend portfolio out of any company that's out there. And actually, can I show it? I don't have my helper today, so I'm on my own here. Let me try to pull up our website real quick. I'm not going to spend a lot of time. I did it. Okay, so on the portfolios page, just check real quick if you want. I'm going to try to make it in here. Right about halfway down, there's a dividend-focused portfolio. If you click on that, The reason why I say we have one of the best dividend portfolios, this is the performance of the fund, by the way. What's really important is the bottom. Everyone looks at performance, oh my God, you did so well, or oh my God, you suck, you're not making any money. The real thing you want to look at is at the very bottom. See where it says volatility? I'm going to change that actually to speed. If I knew how to do that myself, I would do it myself. I got to get somebody to do it. But so I want that to say speed. Do you see how it says on the left? I'm going to go down a little bit. The fund, this dividend fund is moving at 11. The S&P 500 is moving at 12.43. Okay, that is very close to moving at the same speed. You got to check out the video we did yesterday where we talked about speed. Now, what does that mean? So if the markets move, I'm gonna actually do some drawing here. You can see it, right? So let's say the markets move 10%, okay? And this is the gain in the market. And we'll call this the S&P 500, right? Because that's what we use on our website, okay? You want to know, does my portfolio move at exactly the same pace, or does it move some fraction of an amount? Right? And so most dividend portfolios move at like half the speed. They're just so difficult to get any real performance out of that, okay? So what we do is we actually try for our customers to get as much performance as possible with the dividends, but you always give up speed for the dividend, okay? And a great example, actually, if you have the ability to look at these charts right now, here's a great example. Let's do Netflix. That's the first one that I can think of here. Here's Netflix. The symbol is NFLX if you want to look it up. Netflix pays no dividend, right? But it moves much faster than the market. In fact, it's up 114% as of a little bit ago. It may be down a little bit now, but it moves much faster. So if you want speed and you want to outpace the market, Netflix will do that for you over the long run as of now. But you would never buy just one stock, and by no means am I recommending that you buy Netflix right now. I'm just saying Netflix moves faster than the markets. Now, because it can grow faster than the speed of the S&P 500, Netflix knows that. They're not silly. Netflix knows that they are beating the market and they are moving faster than the market, so they don't pay a dividend. You're not going to get paid anything for it, but you don't mind, right? Because you're making all this money if you invested in them. So it's a sacrifice, right? So let me go to the other side of it. And over here, I'm going to go, we talked about Verizon yesterday. Verizon's a big dividend stock, okay? Now Verizon, and actually, let me show it this way. So if the market's moving at 10%, Netflix is moving like 1.2 times the speed of the market, okay? So you know that thing's flying over there. That's ridiculous. That's a really fast mover. Verizon, okay, if we take a look at, where is Verizon here today? Okay, so Verizon's overall speed is 65% of the market. So I'm going to go like this, 0.65. So if the market's up 10%, the best Verizon can do historically over the long run is about 6.5%. But you go, well, that's no problem because they're going to pay me a dividend, right? Well, here's the thing. Most people don't understand how dividends are actually priced into a stock. You guys think that the performance of a stock is whatever it is. Like, for example, let's say Verizon returned 5%. Well, we know that with that speed, actually, if the market was up 10%, Verizon should return 6.5 on average, not every year, okay? So you think, oh my God, I made 6.5%. What's Verizon's dividend? It's pretty good, I believe. Verizon's dividend is almost 5%, okay? So you're looking at that and you're like, okay, I've got 11.5% return. Not the case at all. The way it works is when you're paid a dividend, and do this, check this out sometime because as day traders, they soak this stuff up. Let's say Verizon, I'm going to close this off here for just a second. Let's say Verizon's chart, right? It's moving along, the price is doing whatever, and now at this point in time, they're going to pay a dividend. Every quarter, they're going to pay a dividend. So let's say every 3 months, right? You're going to see a dividend. And let's say the dividend, I don't know what it is, but let's say it's 50 cents. So what happens is if on this day before, Verizon's trading for, I don't know the price right now, but let's say it's trading for $47.50, okay? And you're like, okay, great, the stock price is $47.50. tomorrow they're going to pay the dividend. I'm going to get 50 cents put in my portfolio. You are going to get that, but what they're going to do is they're going to drop the price to 47. So when you wake up the very next day, it was at 47.50. You got the 50 cents, but they dropped the price by 50 cents. So Verizon will start trading at 47. It's called a gap. So there'll be a gap from 47.50 to 47, and you look at that and you go, why is Verizon starting lower? They paid a dividend, okay? That happens every time. So while you think, oh man, Verizon's paying me all this money every quarter, here we go, right? I've got my Verizon shares, it returns 6.5% for the year, plus my 5% dividend. No, it's in there. It's built into the price. So don't fall for that one. That's a big, big mistake. People, they make that mistake. Of course, you would never buy just Verizon, because what happens is, you know that just owning this stock will pay a dividend, but it will never beat the market. It doesn't have the ability to historically outpace the market, okay? So you go, okay, let's add another one, right? Let's do what we did yesterday and start adding stocks here. Our dividend portfolio at Jazz Wealth has 30 stocks in it so that we can get the speed we want. So Dustin, it must just mean that we need to add another stock. But I still want the dividend. What's another dividend stock? What's one that we'll all know? I don't want to pick one nobody's ever heard of. Pfizer. Okay. So let's say you go, Dustin, add Pfizer in there. Won't that help? Let's see. How fast is Pfizer? That's moving a lot faster. That's at 9.1. So again, the example here is if the market was up 10%, Verizon has the ability to be up 6.5%. Pfizer's moving faster. That thing has the ability to almost compete with the market, which seems weird. But I guess the number is what it is. Okay? So now Verizon is going to pay their dividends 4.74% at the moment. Okay? So that's what they're paying. Let me see. Can I find Pfizer? 3.73. So Verizon, you're like, oh man, I got a little dividend there, 4.74. I got 3.73 here, but I sped up my portfolio now. So where I was only moving at 65% of whatever the markets did, that sucks, right? About half. Now what happens if I add this in there? Well, if we do like a portfolio weighted beta, I don't want to use too geeky of words, but if we were to take these two together, what would we get? Now what would be the new speed? 1 second. Nope. No, it wouldn't be. If we put them evenly, if we did 50-50, you got to watch the video from yesterday if you're not sure what I'm doing here. 0.7. So we'll say 7%. Okay? So now if the markets move 10%, the speed of this portfolio should be about 7. Not perfectly every year, but now it has the ability to do about 70% of whatever the market does. Cool, right? Now we've sped this portfolio up. We got a 0.5% better, basically, or we got a small uptick in speed. Now Netflix is over here going, I don't care. You guys do whatever you want because we're flying. We're just killing it. And Netflix is ridiculous, so they don't pay any dividend. But over here, now we've got a portfolio that's moving. It's not going to beat the market. You're never going to wake up and go, oh man, I'm killing it. I'm crushing the market's returns. And this is why people say advisors don't beat the market, right? Because if I had customers that were all 55, let's call it, say 55 to 60 years old. If all my customers were in that category, not a chance in hell I'd put them in Netflix. So I would put them over here or even something more conservative, which means we have no chance to beat the market by design, okay? So by design, we make those portfolios for you. If you say, I don't need to beat the market, Dustin, I do want that dividend and I do want a little less volatility, right? I don't want to be, kicked around as much when the markets fall. So we'd start building something like this for you. And in this case, as long as you know this dividend down here is part of the return. This dividend is part of the return. As long as you know that, that's like the most common dividend argument that I get. People go, I just don't see how it makes like perfect sense for me to do this. I'm getting 6.5, I'm getting the 4.74. You're not. You're getting 6.5 if that's what it returned, okay? Now, if Verizon fell, if these two portfolios fell, you're still getting the dividend, right? But now you've got a little bit of a loss on the stock. Not really a big deal. Most people don't care about that, okay? Whew. All right, did we cover it? Does that make sense? Yeah, there's a couple other, you got some other dividend stocks in there as well, right? And so this game can continue, right? So you could say, I've got Verizon, I've got Pfizer, I ran out of room here, but you could essentially keep going this way and this way and this way and this way, adding more and more stocks to try to speed it up. Like in our portfolio, we went up to 30 and we said, okay, that's it, fast enough. With the way the markets are right now, we only need 30 names to achieve our goal. And so what this ends up looking like, our portfolio is, that's why I think it's the best, because you're getting essentially the best of both worlds. You're getting 30 stocks, so you're really diversified, but you're getting performance that's almost as fast as the markets. Not quite, but it's like 96%, okay? So how awesome is that? Now, you don't necessarily need to take that risk. You could go more conservative and look down our other portfolios, still get dividends, by the way. But this one was to say, how fast can we move and still get every dividend that's available as big as possible? We want as much money coming into that portfolio as possible in terms of dividends. We just want growth too. Can we get some growth along the way? So remember that whenever you look at dividends, you are typically sacrificing some growth. In our example here, we were sacrificing some growth. This was Verizon, this was Pfizer, right? So we know that these two stocks are not going to reach the level of the market, okay? But we sacrifice that because we want that dividend. We're saying we don't need that growth, we'll take it for the dividend. And that's one way to look at it. Now, the argument of this video was if you are young, then you don't want this. Okay? At least all of your portfolio you do not want in dividend stocks. Unless for some reason you are severely averse to risk and you just don't like the idea of risk at all, okay? You don't want dividends. You want growth. Now you don't want Netflix, right? You don't want to buy one stock, but you want to look at our aggressive stock portfolio. Back to the speed thing for a second. That's where now we're saying this is the Jazz Fund, the aggressive stock portfolio. Now we're diversifying again over many stocks, but still getting that speed that's much faster than the market. That's so important. I want you guys to remember very, very vividly that picking a winning stock, that's fun for the short games, right? When you're just going to be a trader, you're going to have some fun. I did that for years. It's a blast, whether you're trading for 5 minutes or for 5 days. I can't explain to you how fun that is. But when it comes to your retirement, when it comes to long-term investments, mutual funds, the hedge fund managers, they can't take shots with money like the day traders do. They have to report back to customers to say, I promised you we'd move faster than the market, and we did. I promised you we'd move slower than the market and get dividends, and we did. That is so, so important, right? We can't take chances over a 35-year period, get to your retirement and go, sorry. You know, I thought Tesla was going to be a big winner, and turns out it wasn't, right? You can't do that. I have to be able to quantify to you with whatever your risk tolerance is, and that's why we put those we put the performance on our website, and I'm going to change that bottom thing to say speed, because I want you to know that I don't care if there are 30 stocks in here and 2 or 3 are down 20%. Is the speed of the portfolio moving in the right direction, and are we beating the market? Yes? Great, no problem. When we rebalance, maybe we kick that one out at some point, but what one stock does doesn't matter. And I get a lot of emails from customers that are like cheering a couple of the really big winners. I don't care, right? I'm not going to say, oh yeah, I knew it was going to bounce. I didn't know. I knew how to make a portfolio that would move at a certain pace. I promised you I would move at that pace, and that's what we do for our customers at Jazz Wealth. So if you've never heard of us before, check us out at Jazz Wealth. We're constantly improving. Tonight, we're going to do our nest egg overview. Brand new nest egg, right? Get your dough straight. We've got a whole software feature, our partnership with Right Capital. Just so excited about this. We're going to go over it. I'll be right here. We're going to go over top to bottom, everything you need to know about that. If you should have the email if you're one of our customers. If you have not switched over yet, just send me an email. Let me know you want to switch over, and we'll do that. So I see you guys chatting away there. I'm assuming you're talking to each other. Yeah, a couple good comments there. Yeah. The trick is, certainly, if you're going to pick a group of dividend stocks and then just leave it alone, not so good. You might want to get some help. I hope you keep us in mind that, of course I'm going to promote myself, but you do want to sort of pay attention to that, especially when the markets get volatile. When things start to get a little shaky or the economy gets a little shaky, keep a close eye on your dividends. We watch every one of them every single day. We don't mess around with that. But all right, I'm going to leave you there. I appreciate you guys coming by and watching. If I've helped you in some way, hit the subscribe button. We really appreciate it. Turn the bell on, and that bell sometimes lets you know when we go live. You don't have to watch, but at least you know we're there if you have a few minutes at work. Otherwise, 4 o'clock today, we'll do our stock market update. 7 o'clock today, we're going to come back and do the nest egg overview. All of our customers should have the email as a reminder, and we'll see you then. Thanks for watching.